Biology of FOMO. Part 1, Understanding the Beast, the Psychology of FOMO. Chapter 1, The Neurobiology of FOMO. The fear of missing out, commonly referred to as FOMO, is more than just a catchy acronym. It is a powerful psychological phenomenon that influences our decisions, especially in high-stakes environments like trading. Understanding the neurobiological mechanisms behind FOMO can empower traders to recognize their emotional triggers and make informed decisions rather than impulsive ones. This chapter delves into how our brains react to FOMO, the role of neurotransmitters, and the evolutionary psychology that shapes our modern trading behaviors. How your brain reacts to fear of missing out. When traders experience FOMO, their brains undergo a series of biochemical reactions that can cloud judgment and impair decision-making. At the core of this is the amygdala, the brain's emotional center, which becomes activated in response to perceived threats or opportunities. When we think we might miss out on a lucrative trade, the amygdala triggers a fight-or-flight response, leading to heightened anxiety and impulsive actions. Neuroscientific research has shown that the anticipation of a reward activates the brain's reward pathways, primarily involving the release of dopamine. This neurotransmitter plays a crucial role in motivation, pleasure, and reinforcement learning. The prospect of winning can create an overwhelming urge to act quickly, often leading traders to make hasty decisions without thorough analysis. Conversely, the fear of loss activates the release of cortisol, a stress hormone that can further impair cognitive functions. High cortisol levels can lead to poor decision-making, increased anxiety, and cognitive distortions, making it difficult for traders to remain objective. Dopamine, cortisol, and the instant gratification trap. The interplay between dopamine and cortisol creates a volatile emotional landscape for traders. Dopamine is often referred to as the feel-good neurotransmitter. It reinforces behaviors that lead to reward. In trading, this means that successful trades can create a feedback loop, prompting traders to chase after more wins to experience that euphoric dopamine rush again. However, this instant gratification can trap traders in a cycle of impulsivity. The desire for immediate rewards often overshadows the importance of long-term strategies and disciplined trading practices. As a result, many traders may find themselves entering positions without adequate research or risk assessment, driven by the thrill of potential profits rather than a rational evaluation of the market. On the other hand, the stress associated with losing trades can spike cortisol levels, leading to a defensive mindset. When traders operate in a state of heightened stress, their ability to think critically diminishes. They may become overly cautious or, conversely, take reckless risks to compensate for previous losses, further entrenching them in the FOMO cycle. Evolutionary psychology and modern markets. To understand FOMO fully, it is essential to consider the evolutionary context of our decision-making processes. Throughout human history, survival has hinged on our ability to respond quickly to threats and opportunities. Our ancestors who were more attuned to their environment and reacted swiftly to potential rewards, such as food or mates, were more likely to survive and reproduce. In modern markets, this evolutionary predisposition manifests as a heightened sensitivity to social cues and market movements. The social validation associated with successful trading can trigger FOMO, compelling traders to mimic the actions of others, especially when they perceive that their peers are profiting. This herd behavior is exacerbated by social media, where the visibility of others' successes can amplify feelings of inadequacy and urgency. Moreover, the rapid pace of information exchange in today's digital age accelerates FOMO's grip on traders. News cycles and market updates happen in real time, often leading to a sense of urgency that encourages impulsive trading decisions. The combination of evolutionary psychology and modern technology creates a perfect storm for FOMO, making it essential for traders to cultivate awareness of these influences. Understanding the neurobiology of FOMO is the first step towards mastering the emotional landscape of trading. By recognizing how our brains respond to fear and opportunity, traders can develop strategies to mitigate impulsive behaviors and make more grounded decisions. In the following chapters, we will explore practical tools and techniques to help you navigate the psychological challenges of trading. ultimately leading to a more disciplined and successful trading experience. Chapter 2. FOMO in the markets. The fear of missing out (FOMO) permeates various aspects of trading, from retail to institutional environments. As traders navigate the complexities of different markets, whether it be cryptocurrencies, forex, or stocks, they often find themselves grappling with the emotional volatility that FOMO can induce. This chapter will explore how FOMO manifests in the markets, provide real-world examples, contrast the psychological differences between retail and institutional traders, and examine the influence of social media and herd behavior on trading decisions. FOMO in crypto, forex, and stock traders. Real examples. The cryptocurrency craze. The cryptocurrency market is notorious for its volatility and rapid price movements, which can amplify FOMO among traders. For instance, during the 2021 bull run, Bitcoin surged to an all-time high of nearly $65,000. As news outlets and social media platforms buzzed with stories of early investors becoming millionaires, many traders felt an overwhelming urge to buy in, fearing they would miss out on significant profits. One notable example is the Dogecoin phenomenon, where a meme-based cryptocurrency skyrocketed in value due to social media hype and celebrity endorsements, particularly from Elon Musk. As prices soared, retail traders flooded into the market, driven by FOMO rather than a fundamental understanding of the asset. Many ended up purchasing at inflated prices, only to suffer substantial losses when the bubble eventually burst. Forex trading frenzy. In the forex market, FOMO often emerges during significant economic announcements, such as interest rate decisions or employment reports. Traders who perceive that they might miss a favorable trading opportunity may rush into positions, often disregarding their trading plans. For example, following a positive non-farm payroll (NFP) report in the United States, many traders experienced heightened excitement, leading to rapid buy positions on the USD. Those who entered the market without proper analysis or risk management often faced regrettable losses when the initial market reaction reversed. This scenario illustrates how FOMO can lead to emotional and impulsive trading, undermining long-term success. Stock market surge. The stock market presents its own set of FOMO challenges. During the COVID-19 pandemic, stocks of companies like Zoom and Peloton experienced exponential growth as remote work and home fitness became mainstream. Investors who feared missing out on these stay-at-home stocks rushed to buy shares based on hype rather than solid research. In many cases, these investors found themselves buying at peak valuations, only to see their investments decline as market corrections set in. The euphoria surrounding these stocks exemplified how FOMO can distort rational decision-making, leading to poor investment choices. Retail versus institutional psychology. Understanding the psychological differences between retail and institutional traders is crucial in addressing FOMO. Retail traders. Retail traders often lack access to the same level of information and resources as institutional players. This disparity can lead to a heightened sensitivity to market movements, as retail traders may rely heavily on social media, news headlines, and peer behavior to inform their decisions. FOMO can manifest in the form of hasty trades, driven by emotional responses rather than a comprehensive analysis of market conditions. Retail traders may also face greater psychological pressure, as they often trade their personal capital. The fear of losing money or missing profitable opportunities can exacerbate FOMO, leading to impulsive decisions. This emotional volatility can create a cycle where traders frequently enter and exit positions based on fear and anxiety. Institutional traders. In contrast, institutional traders typically operate with a wealth of resources, including advanced analytics, research teams, and risk management frameworks. While they are not immune to FOMO, their decision-making processes tend to be more structured and disciplined. Institutional traders often have predefined strategies and risk management protocols in place that help mitigate the emotional impulses associated with FOMO. However, institutional traders can still experience FOMO, particularly in competitive environments where rapid decision-making is crucial. The pressure to outperform peers or justify investment decisions to stakeholders can lead to impulsive actions, such as chasing after trending stocks or assets. Social media and herd behavior. The rise of social media has dramatically changed the landscape of trading, amplifying FOMO among both retail and institutional traders. Platforms like Twitter, Reddit, and TikTok have created virtual trading communities where traders share tips, insights, and experiences. While these platforms can foster valuable discussions, they can also exacerbate FOMO. The impact of social media. Social media allows traders to witness the successes and failures of others in real time. When traders see posts about significant gains made by peers, FOMO can quickly set in, driving them to enter trades without adequate analysis. Viral trends, such as meme stocks, can further amplify this effect, leading to massive buying frenzies based on social sentiment rather than fundamentals. Herd behavior in trading. Herd behavior refers to the